What is up, investors? Back again, another stock analysis. This one I'm excited about. We're going to take a look at two companies that are almost in the identical space here. We'll take a look at Coca-Cola Company, ticker symbol KO, and Pepsi, ticker symbol PEP. Full disclosure, I own a couple shares of Pepsi, but I like both brands equally. If you hand me a Coke or a Pepsi, I'm down for either one. Now, I know the title of this video and the thumbnail and things like that might seem like this is a battle. We're comparing these two, like we're comparing the Yankees versus the Red Sox or the Lakers versus the Celtics. First thing you learn from this video, guys, is investing is not a competition, okay? You can equally like Coke as you can like Pepsi. You can equally like Walmart as you can like Amazon. I see so many investors make the mistake and give up fortunes of dollars by saying, I love Walmart and therefore I'm never going to invest in Amazon. Obviously, that would have been a big mistake. So don't make that mistake, but it could be that Pepsi or Coke might be a better investment than the other. Let's take a look at a high level here. We'll take a look at some of the metrics, then we'll jump into some of the financials here. And then finally, I'm going to take a look at the chart. Not something I always do, but we'll take a look at the Pepsi chart and the Coca-Cola chart. I think that's going to open your eyes. We'll do that. It might give you an idea where you can pick some of these shares up. And I think that's going to be really interesting. So Coca-Cola's got a market cap about $200 billion. They've got a dividend rate here about call it 3.5%. That's not that bad. PE ratio of about, we'll call that 23. Now Pepsi, a little bit smaller market cap, about $189 billion. Not that much smaller. We've got a similar dividend yield, about 3% here, and we've got a very similar price to earnings ratio at about 27. So these companies actually are very, very comparable when you compare the dividend, the PE ratio, and the market cap. The market is valuing these companies in a very similar way. Now, both these companies reported earnings within the last week, so let's jump into it. So we're taking a look right now at Coca-Cola. We've got a 6-month ended view here. We've got top line revenues here at 18 in the previous period, and we ticked down about 16% down to 15 billion. Now there's some things obviously going on in the world right now, and Coca-Cola sells into a lot of restaurants and fast foods, and a lot of these places are either on reduced capacity or they're closed altogether. And so I can imagine Coke has experienced some adverse conditions to that. So we see revenues ticking down here for the 6-month period. Cost of goods sold ticked down almost the same thing, showing you a very efficient business that they're running here. Let's move down through operating income. We've got down from 5.4 billion down to 4.3 billion. That's a 20% drop as well. Finally, coming down to net income, let's figure out where that is. Net income right here, we went from 4.2 up actually to 4.5. So they drove some efficiencies here in their cost, and they actually drove up net income as we moved through the quarter, despite seeing a 16% drop in sales and a 20% drop in operating income. So that's something that you like to see. Now, jumping over to Pepsi, analyzing the same situation, we've got revenue here. What I did was I actually dug into this a little bit. I think this is a little bit more how you want to analyze Pepsi. Coke is a little bit more, I would say, less diversified. They're more of a beverage company, whereas Pepsi is kind of a beverage company and also like a snack food company as well. So we have Frito-Lay here, and we see that business actually did really well for 12 weeks. We'll actually take a look maybe at the 24 week, since that's the term that we did with Coke. So we see that actually ticked up nicely. So people are sitting at home. They like I love bags of chips. And so I certainly understand that, when you're at home and there's not much going on, maybe you're going to grab a bag of chips a little bit more often. And that's definitely happening. We've got Quaker Foods. We actually saw really nice growth here in the quarter, and we see it in the 6-month view as well. Quaker Oats, not an explosive growth, but this is like a pretty well-established brand. So to see this kind of growth over a 6-month period is actually pretty nice. Again, probably some stay-at-home things, people eating breakfast and their oats more at home, and so that's driving up sales here in the Frito-Lay. Now, offsetting that is just like the Coca-Cola that we looked at, the beverage is down a little bit. We actually see more of a downtrend here in the last 12 weeks. It's interesting. Stretch it back to a 6-month view, and we're actually seeing barely a decline. So Pepsi's actually, in my opinion, holding up a little bit. We see here in the 6-month view here, we actually see that revenues back here were 29 billion. They ticked up close to 30 here. So we're seeing a little bit of an improvement, but more of a flat line for Pepsi, but it's a less of a drop than we saw with Coca-Cola. And that's kind of evidence of Pepsi having a little bit more diversified business with the snack food and the breakfast foods with Quaker. So that's kind of interesting. Now, operating profit for Pepsi actually went down, so they didn't drive the efficiencies that we saw with Coca-Cola. We went from 4.7 down to $4.2 billion. Let's stick with Pepsi. We'll move to cash flows here with Pepsi. We see net income here. We didn't see that on the previous page, but they pull this down. We've got a 6-month view here. We saw net income actually go down. Like I said, they didn't drive the efficiencies kind of in the cost structure that Coca-Cola did. So they actually saw less income despite slightly rising revenues and operating income. We come down here to net cash. Cash flow still relatively solid here with Pepsi. We see that it actually ticked up in the quarter. We got $1.4 billion in free cash flow. You like to see that. Now, moving through here, one thing that we'll see with these companies is the issuance of long-term debt here. Notice this, we did 1.1 billion and we paid off 2.9 in the previous period. Boom, like we're seeing with a lot of companies, money is cheap and the Federal Reserve is just buying bonds of these companies. And so boom, we went all the way up to 10.5 billion, really shoring up the balance sheet, and we didn't pay a lot of it off there. So look at this. Last year, we had actually paid off financing activity. Whenever you see this, this means they kind of paid down debt or paid obligations here, whereas boom, cash flowed into the company here at the tune of about $9 billion. Now, jumping over to Coca-Cola's cash flow statement, we're actually seeing a little bit healthier cash flows, at least on the 6-month view, but notice they actually went down quite a bit, whereas Pepsi's actually went up. So everything's kind of like flip-flop with these companies. Coca-Cola's net income went up and Pepsi's went down. Pepsi's cash flows went up and Coca-Cola's actually went down. So it's interesting, the kind of tugs and pulls that we see on this business. This is still really, really solid cash flows. Now, moving down to the financing activities, we'll see that Coca-Cola did the exact same thing that Pepsi did. We had the issuance of debt here. Notice they're kind of playing like almost like the refinance game that people play with their house. So they did $14 billion issuance in the last period, but they paid off a lot of that. So they probably paid off a previous loan. Whereas now we're a little bit more aggressive here. We did 19 billion, but we paid off about 10. And so they refinanced a smaller chunk, kept more onto the balance sheet here. We see here that cash provided by these investment activities or financing activities went up to 8 billion, whereas it went down to 1.5 billion. And we see cash here at the equivalents went up by about $4 billion. Sticking with Coca-Cola, we'll take a look at the balance sheet here. Coca-Cola current assets here. We see evidence of that debt raise here. We've got $6 billion in the previous, actually not previous period. This was at the beginning of the year. Boom, up to 10 billion. We've increased our short-term investments. So we increased here by over $10 billion in cash. So this is a company with lots and lots and lots of cash on the balance sheet. In fact, if you look at total current assets, that includes some inventory. These marketable securities are pretty much cash as well. Got lots and lots and lots of assets here to play with. Now, current liabilities, we come down here to long-term debt. We see that did tick up by 10 billion. That is evidence of the cash increase as well. But again, the rate that these guys are borrowing this money, it's not something that I would be too concerned about. This company, Coca-Cola, very financially healthy in terms of cash flows, in terms of operating income. Everything looks just fine to me if you're looking for that type of investment. Now, finally, before we get over to the stock charts, let's take a look at Pepsico's balance sheet as well. We see again evidence of that fundraising here. We went from 5.5 all the way up to $9 billion. They've got a little bit more in inventory because they have different kind of packaging that they need, and different kind of snack foods and things like that. So they've got a little bit more here going on the inventory side, but nice asset side. Come down to the balance sheet here. On the long-term obligations here, we've got this long-term debt. Their debt also ticked up by about 10 billion. It's amazing. These companies are doing like the exact same thing. One raises about 10 billion, the other one raises about 10 billion. Everything is very much in line, and so these companies do very, very similar things, despite being somewhat different in terms of what they do in terms of snack foods versus just a beverage company. Now, let's jump into this chart. We got Pepsi here. This is on a daily view. We see that this stock, obviously, like a lot of stocks, was making a really, really solid run at the beginning of the year, and then boom, we had this big crash, in March timeframe. And like most stocks, or a lot of stocks, I shouldn't say most, but a lot, did this boom, this V-shaped recovery. And now a lot of them are trading sideways here, just kind of like treading water, so to speak. So with Pepsi, it's interesting. Your downside is probably somewhere in this range, probably retesting the sideways action lows. I don't know if we'll retest these lows. This seems, the odds, I think we go back here. Look at all this volume down here. I don't know if we retest these lows. I think if you're hoping to pick Pepsi up again at $100 a share, you might be waiting a little while. I don't want to say it'll never happen, but you might wait a little while. But I think it's possible that this stock comes back down and retests these, 128, 130. And your upside in this is probably coming back up into this range. I would call it 140 to 145. To me, that's not a huge risk reward, but it's not bad. You're probably not buying this stock for like this huge pop. It is in a short-term uptrend here as well. But I think this stock, like a lot of stocks, are probably going to chop around for a little while until we get like a clearer view on what's going on with the economies and things like that. Now, Coca-Cola, little bit different situation. We see it did, just like Pepsi, made a huge top and then boom, crashed down, moved up, probably not quite as high as Pepsi. Pepsi kind of came all the way up to kind of the almost the top of its range. If Coke were to do that, it'd actually come all the way up into here, into this $50 range, but it hasn't quite done that. It's kind of made this W formation here. It is in a short-term uptrend as well. And I could easily see this stock at some point here pretty soon kind of retesting this $50 mark. And if it actually breaks through that $50 mark, it could easily, see this gap here? I think this stock could easily fill that gap and come back all the way up to $51, where I think your downside in this is probably just about $5 lower here. It's probably only about $4 or $5 lower. And if it comes back, if Coke pulls back to these levels, I would say $44, $45, I would definitely be looking to start a position here, because yes, could the stock retest down here at 38, 39? Yes, possibly. Like a lot of stocks, it could do whatever it wants, but I think this stock is probably financially healthy enough with the debt that they have and the balance sheet that they've got and the cash flows. I think this stock would be interesting here at this $44 range. Now, if you miss it there, it's probably going to come up here to in the $50 to $51 if it keeps this uptrend, and it'll probably hit its head somewhere up in here. But I actually think there's a little bit higher upside with Coke, or at least in the short term. I think both these stocks are your typical buy and hold kind of things. You're reinvesting these dividends and you're holding this for the long run. Now, these dividends aren't enormous. They're not as big as like AT&T or Verizon or some of the REITs that you have out there, but these companies are very, very steady even in today's environment. We see in terms of their balance sheet and things like that, this is just a really, really steady company. And so I actually like probably Coke right now. If I were to have to, if somebody was forcing me to buy one of these stocks, I would probably prefer Coke, because if it does break this like little uptrend here, these little higher highs, it's going to make a higher high all the way up into probably the $51, maybe even $52 range. And if it keeps that momentum, it could easily get up to into 55, where I think your downside downside here is 44 bucks, probably a couple bucks under the shares here. I definitely, if I bought this stock, I would put a stop loss somewhere in here in the $44 range. And with Pepsi, I would definitely do it in this call it 125 range, because if it breaks there, if either of these companies break that, it's probably off to the races to the downside, and there's probably some macro environment stuff that's happening that would not be beneficial to all stocks, let alone these two. So hopefully that helps you guys out. Hit that subscribe button. Thank you. I have like probably over 1,000 new subscribers just in the last few weeks, and tons of comments. I wish I had time to get back to them all. I'm getting hundreds of comments a day. I just want to thank all you guys. You're helping me stay motivated to stay doing these videos. If you have any suggestions, any criticisms, whatever it might be, leave them in the comments below. For those of you that are upset about the sound quality, I have a new microphone coming soon. It is a very expensive one, so that should improve as well going forward. Thanks for tuning in. Good luck with these stocks and good luck with your investments.